My name is Lan Turner, and this is the final lab for the week of our university class down at Utah Tech University, where we were having our options class. And so we're going to tie this up today. We're going to go through the final slides and look at the options that we had in there. The one that's primarily left is the wheel strategy. We're going to look at that, and we're going to do the protected wheel. We're going to look at a little different strategy, not just straight up the wheel. We'll do both so you can see the difference. And then we're going to go through and we're going to look at some markets, because I've been working on SFO magazine, and SFO magazine is publishing some trade recommendations, and one of them is in, well, there's a bunch of them in there this time. So C Boss is saying he already misses everybody in class. So it's not like the labs are over. It's just the last one specifically tied to that one class. We'll be here next week. All right. Still going to do class. Actually, I'm going to go take a little vacation. I'd probably go traveling. Well, probably maybe not next week. I think Wednesday I'm going to take off, but we'll still be here probably Tuesday and Thursday. Who knows? We'll see. And then the week after that'll be the one where I'll probably go take a little time off. But we'll see. The semester's over, but we're not done. Just because we stopped teaching classes down at the university doesn't mean that we're going to stop teaching classes online. These classes will just keep right on going all summer long, and then we'll pick back up live at the university. So there'll be both. Don't worry, we're not going anywhere. Okay, so your TA is better. Your TA is better. All right, my 14-year-old brain kicked in. I don't know what TA is. All right, unless it's my 14-year-old brain. Great, glad to hear your TA's doing a little better. Is TA your stock? Is that a stock symbol? I don't know. I'm trying to bring it back out of the gutter. Okay, let's see. There's John Gaisley in there. John, hey, I wanted to ask you, man, are you feeling any better? John got sick on Friday and had to leave class early, and he looked like he was going to drop dead when he walked out of that room. I was really worried about him. Oh, your technical analysis is getting better. Okay, yeah, that's good. That's market related. Glad to see your technical analysis is getting better. I think that technical analysis, in my opinion, is the most important part of trading. And I've said it a million times, if you can't determine where the market's going to go, you're going to have a really hard time making money. That's the whole name of the game. I mean, it's a carnival game, and the name of the carnival game that you're playing is, where is that little green and red snaky thing going to go? And when you get good at predicting where that little green and red snaky thing is going to go, that's where you make all your money. It's when you can't predict where that little green and red snaky thing is going to go that you can't make money. You lose money. So that's when people just end up saying, well, I'm just going to buy it and hold it forever, because markets go up over periods of time, right? Well, usually, sometimes. So, all right. So John says he's feeling better. Glad to hear it, John. You looked rough, man. You looked rough, and I was feeling kind of bad for you, and you walked out of class. I was like, that looks like he's sick. It doesn't look like he's mad at me. I didn't say something to piss him off to make him leave. He looks like he's in rough shape. All right. Had people get up and walk out because of things I said before. I try not to do that anymore. I don't know. You guys know me. I have no filter. Me and Donald Trump probably very neither one of us have a filter. Did you hear what he said the other day? Oh my goodness. Okay. Well, we won't go there. No filter. So here we go. Let's talk about a synthetic long position, shall we? This is what we left off on. Wednesday? Yesterday morning. We were talking about synthetic longs, and they're very cool. We love them, right? We love synthetic longs because you can control the same amount of shares with options as you can make the same amount of money up and down with the market with a synthetic long as you can with the shares themselves, but you don't have the cost or the expense. The problem is that you're limited to the time, right? It limits your time, but you could buy a lot of time. It just costs a little bit more money, but it's still way less than what if you were buying the shares themselves. You can buy a year of time, and it's like, if you're a trader, I'm not talking about long-term investors, but there's nothing wrong with that either. Long-term investors, you're buying for 30 years, but you could buy 1-year options 30 times and get the same thing. And it'd be significantly smaller dollar amount, so your return on risk is much higher. And then you can sell covered calls against it and everything. So it's just the same as if you own the share. So synthetic longs are very cool. All right, we talked about those. So we're going to come in here and we're going to talk about, now this is synthetic long with a soft stop. We talked about that. We're going to do some of those today. And then this is synthetic long with a covered call. We talked about that. And so we go and put our synthetic long and we sell covered calls against it. Very cool way of doing it. Now this is one strategy that we use this with is it's called the poor man's covered call. So what you do is you go in and you buy a synthetic long position and you do it deep in the money. So it's like got deltas of really high, like down in the delta range of, for the call, it's delta of 70 or 80, maybe even 90. And then you can sell covered calls against it. And as the market rises, you're almost at a 1-to-1 ratio with the underlying market. You're at the 1-to-1 ratio anyway, but you can do this. It's just a nice way of being able to do long term. You buy like 1-year options deep in the money, and then you just sell covered calls against them for a whole year. It's just an income method. You can go. We can talk about it more in another class. It's not something we all want to talk about today, but you can go research that. It's called a poor man's covered call. All right. So if you want to go look that up on YouTube and learn a little bit about a poor man's covered call, that's kind of a fun way to do it. All right, cash secured put. This is where we got to. This is what I want to talk to today. This is where we're going to lead you into the wheel strategy, and then we're going to go from the wheel to a protected wheel. And this is one of my favorite strategies. This is one I like to do a lot of. I like to do I'll show you another one I like to do a lot of too. All right, it's going to circle back around because I'm going to go through and look at actual markets today. So we're not just going to kind of go grab one market and just do a whole bunch of things on that one market like we did before and just show you how they work. We're going to go actually put some on. So we're going to do this cash secured put. So I want to run down through this really fast. Cash secured put is just where you you sell a put option. And all that means is all you're telling the market when you do that, you sell a put option below the market, you're just saying, hey, I want to buy the shares right here. That's all you're really doing. It's like putting a limit order down there, a buy limit. If the market comes down there, you can, and hits the expiration date. It's got to hit the expiration date. It doesn't have to, but let's say it's going to hit the expiration date. By expiration, I mean, somebody could actually do it early, but most likely they're not going to. Okay, so at expiration, they're going to give you the shares. So you're going to sell one put, you're going to collect a premium, and then if the market goes down there and touches the purple line or touches expiration at the price, at the strike price you put in there, you get the premium plus you get the shares. So it's just like a limit order, but they give you money for putting a limit order in to buy the shares. So you never really want to do this on a market that you don't want to own the shares on, because that's the whole point of putting a naked put on there is you want to buy the shares. And it's cash secured, meaning that you have the cash sitting there waiting to buy the shares. So that's what you're doing. Now, the further away you push that, let's go over and do it. I'll tell you, it's easier to show you. All right, let's come in here. And these are the markets I want to look at today. So this is in SFO magazine. SFO magazine is putting out a whole bunch of trade recommendations this month, starting in April. It comes out next Wednesday. So look forward to that. If you're not subscribed, go over to pick it up, sfomagazine.com. Get you a subscription. It's only $39 a year, and it's a fantastic, man. This version really turned out nice. So Claire and her team are really putting together a nice magazine this month. I don't even have an article in it, so it's not all about land this time. Okay, so it turned out really nice, and they're not done. They're still working on it, but they'll have it done. It'll be polished off by Wednesday for sure. But it's got a lot of trade recommendations in there, more than I've ever seen them give, and so it's really nice. And one of the trade recommendations is the military contracts because of the war. Right, we got to look at that. So this is the reload contracts they're talking about. Now you got to watch that. You got to listen to that article. It's really super good. And of course, it's the one that's being highlighted in the what do they call podcast? SFO on air. It used to be Pit News on air, but now it's changed. It's SFO on air. So anyway, General Dynamics. We got this is actually IT. Let's go through. I'll do that one last. We got L3 Harris Technologies. These are all big government contractors. Oh, this one here we were playing with. So let's go ahead and we'll clear this one off for right now. Exit all options. No, not that. Not all. Sorry. Exit chart options. Yes. Okay. Clean that up. Delete all drawings. Okay. So you got LMT, Lockheed Martin. Lockheed is kind of like the grand poobah of them all, right? And we got Northrop Grumman. We got Palantir. Palantir's flushing like a toilet today. Good thing we got a put option on there. And then RTX or Raytheon. So Raytheon is another nice big one. So you've probably heard of all these. So these are just big government contractors, and you can see they're, this is the buy the rumor, sell the fact. So the rumor was we're going to war, and then the fact was we went to war. Okay, so the buy the rumor, sell the fact. Buy the rumor, sell the news. Here said either way. I like buy the rumor, sell the fact. So there you go. That's what's happening. And so these markets are flushing. But what's going to happen? How many bombs are we dropping? A lot, right? A lot. We're dropping a lot of bombs. And so what does that mean that they're going to be doing here soon? What does it mean they're going to be doing? Restocking the bombs, right? So the government contracts are starting to roll in where they're going to have to restock all these bombs. And not only are they restocking them, they're going to get more. You heard that Trump said he wants to raise the budget for the military from 1 trillion to 1.5 trillion, $500 billion more. You know why? China. Do you guys all want to speak Chinese? I don't think so. So this is why they're in a hurry too, because they're worried that China wants to take Taiwan, right? So okay, I'm getting interrupted here. C-Boss saying retail traders need to have a check every week. We're going to talk about that today. That's what we're doing. All right. This is trading. This is not investing. So there's a big difference. Investing means you're going to buy and hold for a long time. And at the end of your life, you're going to have a big pot of gold at the end of your life, right? That's not the way I like to trade. I like to have little pots of gold every month. And so I've showed that chart a lot. Do you want one big pot of gold at the end of your life, or you want a whole bunch of little pots of gold along the way? Because if you take little pots of gold along the way, well, you're most likely not going to have a big pot of gold at the end of your life because you're taking it out and you're spending it along the way. Most people, like you see, boss, they want to have income. So at the end of your life, you're not going to have a big pot of gold. Now you can do a little bit, so you can try and do a little bit of both, right? You have a bigger, littler pot of gold at the end, so that you don't have to do as much trading when you get older. But that's okay. You can run it however you want. But we're going to show you that's what these strategies are all about. It's trying to make money during your life, right? Give you money now. That's the whole idea. Take money out of the market. Stop putting money in. Anyway, back to my story. Here we go. China wants to take Taiwan, and some of the rumblings is that they're worried that now that we've depleted all of our munitions on Iran, that now would be a good time to do that, because then the U.S. would be short on munitions, and well, we'd be SOL, right? We wouldn't have any bombs left to drop. Couldn't get in a war with China. So now over Taiwan. So now what they're doing is they're ramping it up. They're saying, okay, well, the budget was at 1 trillion. Now they're going to take it to 1.5 trillion. We're a warring nation. Yes, we are. People are like, oh, we don't like have wars. We've been in a war my entire life. There's never been a time. Trump is the only one who's ever not had a war. I mean, and now he's got a war. So, I mean, every single administration my whole life, we've been at war. This country's been at war my whole life. So to say, oh, we hate these long-term wars. Sure, we hate the long-term wars, but it's not like it's unusual. Okay. That's how this country makes money. Why do we not have nice things? Because we have nice war things. We're the policemen of the whole earth, right? We have to go around and make sure that everybody's boats are able to float through all the different canals and waterways and everything. We have to protect everything. We protect. That's the U.S.'s charter. That's what we do. We protect trade around the world. We protect strength and, well, sometimes depends on who's in the administration, but sometimes we do, sometimes we don't. Sometimes we're a little bit lackadaisical on that. But right now, we run out of bombs, for whatever reason. And nobody wants to be in a war. We don't want, people don't want to be in a war, but people who are in the war business want to be in war. You think all the people that work for Lockheed Martin don't want to be in a war? No, they do. They want to be in war all the time. Why? Because that's how they make their living. That's how they make money. So a big part of this economy is the war, right? We're a war machine. So That's what we have. We have really nice war stuff. So that's what we spend all our money on. And so these are the companies that do that. And do you want to join that and not be a part of that or not? Make money on the war. I don't know. I'm not going to try and be an ethical person here and make ethical decisions or talks about it. I'm just going to talk about making money. These are the little snaky things that go up and down, and who cares about what's behind them, right? Where's this little snaky thing going? Well, it looks like to me it wants to go up. It's been trying to go up when all the rest have been going down. That's general dynamics. So what we do is we come in here and we have different strategies to play against these little green and red snaky things to see if we can make money. If the snaky thing goes down, well, we can make money when the snaky thing's going down. If the snaky thing's going up, we can make money when the snaky thing's going up. We just have to decide which it is and make our decision based on that strategy. Now, most little snaky things go up. That's kind of the way things work. And there's lots of dynamics why snaky things go up. Well, snaky things go up over time because the company's doing well, making money. Well, that's one reason. The other reason is because over a long period of time, the US just keeps printing money, printing money, printing money. That makes all of your assets go up in value, right? And so it's called quantitative easing. So quantitative easing, printing money, printing money, printing money makes your assets go up in value. That's why the stock market goes up in value over a long period of time. It's like, well, it's always gone up in value. Well, that's because the US has always printed money over a long period of time. So we print money, print money, print money, and forces your assets to go up in value because it devaluates your dollar amount. So this is on a shorter term scale. That's not really what's happening as much. So we got to look at just the dynamics of the market. So what we're going to do is we're going to come in here and we're going to try and decide whether we think this market's gone down far enough or not. Now we can look at recurring price patterns, and we want to look at previous highs. Like there's a previous high right there. That's important. So look at that. It bounced twice off of that one, finally broke through, came down, went up, created a new one. Now it's coming back right down here and it's touching this. This is called a Fibonacci bow tie. So a Fibonacci bow tie means that it came off here, down here, touched this one, went up, touched that one. Now it's right back down here to the previous high. See that? That's a Fibonacci bow tie. It's on the cover of my book, that pattern right there. It's so important. That's how important that pattern is. Markets do this all the time. They like to use previous areas of resistance as areas of support. And they go up and around through these things. That's what little snaky things do. Little snaky things, red and green snaky things on the screen do that. So when it gets down here, this is generally a good time to figure that the market might turn around and start going the other way. So if it's down in here, we're down here into the one standard deviation right here. That's the one standard deviation. And so we're going to anticipate that the market's going to probably start turning around in here. Now, it's not probably going to, I don't think it's going to just turn around and go shooting straight back up. Not that it can't, certainly can. That's called a V recovery. All right, V recovery, Victor, because it looks like a V. Those are rare. It doesn't happen all the time. Sometimes it does. Here's a little down, little sideways, and then kind of almost a V recovery, and it went almost straight back up, didn't it? Now, it had a little bit of a drop in here, a little bit of a drop in here. So it wasn't quite a V recovery. It had a drive 1, had drive 2, and then a big drive 3, and then it flushed down again. And then it had kind of a nice little recovery there. It did have a little pullback in here. So it kind of topped out up in there. Now it's down here. So what are we going to think that this little snake's going to do next? Because if we think the little snake's going to turn around and go back up now that it's down here in the one standard deviation, we might want to buy some shares, right? So if we want to buy some shares, but yet we're scared because it might still go down, what do? This is what we do. This is very simple. This is probably the best strategy for new traders just getting into options. You're going to come in here, and the very first thing you're going to do is you're going to come in and you're going to say, I think I want to buy on this. I want to buy here, and because it might turn around. Now, I'd probably wait until it's today, and we've got to teach today. I probably wouldn't buy right here today. All right, just a caveat. I'm teaching a class. I'm not teaching you when to buy. I'm not telling you that, hey, aerospace defense contractor. This is the ETF. I want to mention that. This ETF has all of these other companies in it. So this is just one stock that has all these other companies in there. So if you want just the individual stock, you just want Lockheed, it's this one. But if you want the ETF, exchange traded fund, that has all of them in it, then it's that one. Okay, so we can go look at that and see what else is in there, because I'm sure it's not just those, but this is an aerospace and defense ETF. This is how you buy the war, all right, or buy war companies. So now let's say we want to buy some shares in here. Now we don't want to buy all of them. Let's say we have 100 shares available that we want to put into this market. Well, we don't want to put all of them in. What we're going to do is we're going to come in and we're going to look at a option, and we're going to say, how long do we need some insurance for? Well, I don't know. We'll probably know within the next, I don't know. What do you say? 2 or 3 weeks? What this market's going to do? Whether we want to be in it or not. So we need to buy some insurance, let's say 2 or 3 weeks times 2. So generally speaking, we like to buy as much insurance as we can because the more insurance we have, the longer the time is on the insurance, the less we lose at the first of the insurance. Remember, we have that drop off on theta where it drops off really fast at the end. So if we buy insurance and our plan is to take some of that premium back, that insurance premium back, because we're not going to use the entire time. Well, we want to have very little loss at the front, right? So what we do is we'll come out here 50, maybe you could do 113 days on this if you wanted, but that's really not the point. The point is you can do it. You could even do a little short one. You could come in here and say, oh, I just want to buy 22 days worth of insurance. You could do that, but then you're going to basically spend the whole thing. Okay. So you can say $480 is what your insurance would be for 22 days. See that? Let's just do the puts because we're doing puts here. Buying insurance because we're going to buy some shares. So $480. See that? $480 is what you're going to pay for that put option. And that's 22 days. But if we go out to, let's say, 113 days, well, now it's a lot more. It's $1,000, but it's given us 100 days versus 22 days. So that means that the market's going to vary at the first of the month in the next 2 or 3 weeks. It's not going to lose hardly anything in that premium. So your insurance, you get a really good rate on your insurance if you buy more. It's block price averaging, right? So you get a lot better, lot more insurance for a lot less. And that means that at the beginning, you're going to have a lot less decay. So you're not going to really pay as much. And if you're only going to hold it for a couple of weeks anyway, you can get that. You pay more for it, but then you get the big rebate. You get most of it back. And that's kind of what we want to do. So you can do 100. It's up to you. It's like, well, Lan, what's the right answer? There is no right answer. You just do what you want. Do you want to pay? You want to have hopes that you can get less premium back? Yeah, okay. Well, or more premium back? Well, get a longer one. Pay less for it. You pay more for it up front, but you get more back in the back end. Or you can just say, well, I want to put less up front. Okay, well, get a 22-day one. Well, why don't I just go halfway, right between the middle? Okay, we'll do that. Cut it in half. It doesn't make any difference to me. It's just the more you buy, the more you get returned. The less you're going to lose up, but it's more you have to pay up front. So do what you want. There's no right answer. If there's one thing you ever learned from me in the stock market trading, there's no right answer. It's just a different answer. You're never ready. You're just willing, right? You're never ready. You're just willing. So what we're going to do is we're going to come in here. And the reason we want to put the put option on first is because we want to determine what the delta is. And we're going to put it right at the money. So we're just going to come in here. We're going to buy a put. Now, why am I going to buy a put if I think the market's going to go up? Well, it's my insurance policy. I want to put my insurance policy on there, and I can see that my insurance policy is going to be $705 because we decide we're going to do the 50-day because we can't decide on the 22. We can't decide on 100. So we're going to cut the bread in half, and we're going to have, half. You get half a loaf, I get half a loaf. We're going to go up 50. That's fine. It's fine. I would probably be more likely to do the 113 because I have enough money to do 113. Why not? It's going to save me money in the long run. It's cost me more money up front, but it's going to save me in the long run. 50 is okay too because we're only going to hold on to this thing for probably, I don't know, a week or so, and then we can dump it. Cost me a little bit more money in the long run, but it doesn't cost me as much in the short run. So there we go, 50 days. So 50 days, and you see that the delta is 42. So that means it's going to make or break as much money as 42 shares. Now, I have 100 shares that I want to put into this market, but the market might keep going down. So what I'm going to do, I want to actually have that right at the money, right? Well, that's as close as you're going to get, Lan. Okay, so we're going to come down here. 42 is what the delta is. So that means I'm going to come over here to my trading tab, and I'm going to buy 42 shares. All right, then come down here to 42 shares. Now I'm going to buy 42 shares. So I'm going to buy 42 shares because my option has a delta of 42. I'm just going to match the shares with the delta. So if I do that and I buy that option, I'm going to kind of buy the option, let's come in. Actually, oh, wait a second. You know what? This is not good. We can't do the 50. Why? Look, there's no volume and open interest. Oh, my hell, ruined my whole deal. Now we got to exit our chart. You can't do it. Close the position. Yes, close that position. We can't do it if we don't have any volume and open interest. So let's see if there's something better. Can we do a 22? No, there's nothing there either. Nobody's trading options on this. You got to be kidding me, guys. All right, well, Don't trade options on aerospace defense ETF. Let's go to General. Let's go to Lockheed Martin. Let's go to Lockheed Martin. Actually, let's go to General Dynamics. General Dynamics looks like it's actually going to try and go up. It's going through, looks like to me, an accumulation stage, and then it went up, and it's trying to go through another reaccumulation stage. It's just a narrow sideways channel. Let's get the bottom of the channel. It looks like it wants to rally. It doesn't want to break down like the rest of them. That's okay. Let's say we want to get into this thing. Stop moving on me, you rotten little booger. There we go. Okay, so we're going to think we want to get into this one. So now what we do is we come in here. All right, we're going to do the same thing. Same argument. Which one do you want? You want one that's got a lot of volume on it. Oh, my hell. Are you trying to tell me this dumb thing General Dynamics doesn't have? Why is nobody trading options on these? I guess I should have looked at them before. I thought that these would all have, look at, none of them have options. Oh, my hell. 50 days. Are you kidding me? What's wrong with you people? Everybody wants to trade AI. Look at that. Palantir is going to have a lot of options. It's AI. RTX. Well, Raytheon's got a lot of open interest. It's got no volume, though. Nobody's buying them today. Nobody's buying put options today. They're just buying, well, they've held a bunch of put options. We could probably pull one off here. Oh, my hell. I'm really disappointed in all these things. I thought we could trade options to the heart's content on these. I pulled that whole thing up there and set it in there so that we could trade options on it, and didn't even look at the options volume till now. Disappointed. All right. Well, we learned a valuable lesson today. You might want to trade options on it, but if there ain't nobody trading options with you, you got to be where your friends are, and your friends ain't here. They ain't trading options on the military. Wow, that's really disappointing. Raytheon's got enough in here. We could probably do something. Nobody's trading them today, but we got enough open interest. So where the spread? The spread's $26. That's a lot of money. Good hell. I'm so disappointed. All right. I thought we were going to be able to have a good day on options. Let's go over to the Mag 7. That's where everybody's at. Go to Apple. I want to trade Apple. Look at the options on Apple. Oh, yeah. Everybody's trading Apple. Why does everybody just want to trade Apple? Why? Who cares what Apple's doing? All right, Apple wants to go up. We want to go up with it. We're going to come in here. We're going to buy a put option. Same argument. Which one do you want? 22 days, 50 days, 113 days. We're going to do 113 days. We're going to come in here. We're going to buy a put. We're going to put it right at the money, as close to the money of where the market's trading as we possibly can. You're going to see down here that your delta is 43. So then we're going to come over here to our trading tab, and we're going to buy 43 shares. That's all there is to it. Just make sure you got plenty of volume and open interest. And if you want to buy one that doesn't have it, well, then you're going to be disappointed. Sorry, nothing you can do about it. It is what it is. Okay, we're going to go ahead and we're going to just buy our, did we buy those? I don't know if we bought them. Buy market. There we go. Okay, so we just bought Apple, and we just bought 43 shares. And the reason we bought 43 shares is because an at the money call, which cost me $1,400, has 43 delta. So 43 delta matches the 43 shares, means that when I buy that put option, okay, we're going to come in here and mark it into it. We just buy it just like that. And we got our put option. Now our put option is going to make as much money on the way down as the shares are going to lose. But here's the key. We got convexity working in our favor. So if the market actually does fall, you're going to actually make more money on your put option than you're losing on your shares. So it's going to be profitable to the downside, and it's going to be profitable to the upside. Oh my gosh, isn't that cool? That's one of my favorite strategies right there. I love doing this. I love doing it. Why? Because it's almost no risk. Because now if I want to take off, what if the market does take off? And it's like, oh man, alive, it's going to the moon. All right, I was right. This market's going up. Well, I don't need all that insurance anymore, right? So I can just kill the insurance policy, get all my premium back, except for what I lost on the rally, which isn't going to be very much, because even if the market goes up, you're going to only lose a little bit of your insurance premium, because it's got 113 days before it expires, and it's got $1,470 to give up. So it's going to hold most of that value. You just liquidate your put option after 5 days, and you decide, well, I don't need the insurance policy. So then the market only has to go up far enough to pay for the 5 days of insurance policy. You get all that money back, and you're home free. Way to go, man. Nice job. But what if the market flushes like a toilet? I've actually made more money because sometimes, you're like, oh, I think the market's going to go up. How many times you bought thinking the market's going to go up only to have it flush down? All the time, right? So if that happens, well, your shares are trading at 100, your delta is at 43, but your shares are you've only got 42 of them, so you don't have 100, but yet the option itself is operating as if it has 100 shares, but it's only at a delta of 43. So that's your convexity. If the market goes down, well, convexity is going to go up. It'll go from 43 to 48 to 54, 59, 65. It'll start making shares as if it's making money at 65, and you only have 42 shares. Your shares won't go up if the market goes down. You won't get suddenly 44, 45 shares, 46 shares, 50 shares, 70 shares. No, you still have 43 shares. But yet the option will increase in value as it goes down. The delta goes up, so you'll start making more money as the market falls, more than you're losing on your option. So it's actually a more profitable trade to the downside than it is to the upside. That's what I'm trying to tell you. That's pretty cool, if you ask me. So you make money either way. That's the best, easiest way, because you're getting into a market you think's going to go up anyway. That's why you do it. You're like, oh, I think this market's going to go up, but I'm going to match the delta. If I match the delta, then if the market goes down, I actually make more money than I do if the market went up. But yet I got my shares. If the market goes up, I take off my insurance premium, get all my premium back, and I'm good to go. Away you go. I do this all the time. Even if I just for test, just for fun. It's like, oh, you think that market's going to go up? I don't know. There's no risk in putting an order on. Why wouldn't I try it? It looks like it might be going up right here. I don't know. Heck, that's drive one, drive two. It's ABC. You just come and do your technical analysis. But technical analysis, there's always a little bit of ambiguity in here. There's always a chance you could be wrong. But you kind of do your best, right? You come in here and you say, well, it's this high. It came down a little double bottom in here. It looks like it wants to rally. It looks like it wants to go up. I don't know, but heck, if you come over here and do your next little projection, right? It could say it's going to go up right there. There's your Fibonacci projection to the upside. Well, it could go up, but here's the Fibonacci projection to the downside. Well, it could go down. We're at a decision point. That's what I call this. So this is a decision point trading. And so at the decision point, you have to make a decision. Is the market going to go up or down? I don't know. Might go up, might go down, might go sideways. Worst thing it can do is go sideways, because if it goes sideways, it's going to burn up your insurance policy. But you got a long insurance premium, 113 days. So you got a little bit of room to burn. That's okay. Go sideways a little bit. You don't want to go sideways for long. If it does, take it off. Wait for another opportunity. Go to another chart. There's lots of snaky things. There's snaky things everywhere. The problem is you got to find snaky things that have volume and open interest on them. If you can find a great little snaky thing, but it's not got any volume and open interest on it, you can't do this strategy. So that is the best thing you can do right there. That's it. If you just did that, if that was the only option strategy you did, you'd be well worth just coming to these classes and learning that that's the one thing you can do right there. Just do that. Just do that. You got no risk, and if the market flushes, you make more money than if it goes up. And if it goes up, you got your shares. Get rid of your insurance policy. Get your money back. How do you practice that? Go in and do it on 10 markets. Here's AMD. We've already got something on AMD. We got something here too. Let's see if I want to Google. Here's Google. Oh, you think market's going to go up on Google? I don't know. Why don't we come down here and we buy a put option? We're going to come in here, 113 days. Buy a put option. What would a put option be? Buy a put. It's going to be $2,000. It's because the market's flushing right now. So you don't want to buy put options when the market's flushing. That's like buying insurance. Thank you. That's like buying insurance after the house is already on fire. So don't do that. So you don't want to buy your option here. You're going to notice that. Look at this. The theoretical value, the Black and Scholes number. See that? It's $1,614. That's what that thing's worth. But if you buy it today, you're going to pay $2,000 for it. You're going to pay $400 more for it today than what it's worth. That's really important to know. That's why that theoretical Black-Scholes numbers, you look at that and you say, well, what's wrong with it? Why is it $2,000 if it's only worth $1,600? How come they're selling it for $2,000 if it's only worth $1,600? Well, because the market's flushing like a toilet. You're buying insurance after the house is already on fire. It's going to be expensive. Okay, so that's what that is. So you don't want to do that one. So you could do the opposite. You could short the market. You say, well, I'm going to buy a call. All right, well, yeah, you can buy a call. You could do the backwards thing. Buy a call. Buy a call right there. That should be cheap if we come over to calls. Call. Well, it's not cheap anyway because the implied volatility is way high. Well, 37, that's not too bad. But the theoretical value is 2,157. So it's only worth 2,157. They're still charging you $2,400 for it. Even a call option, that's a lot of money. It's like you're paying a premium for it. You're not getting it even for the price it's worth. You're paying a premium for a call option when the market's going down. That's ridiculous. So then you'd want to short the market if you did this. So you'd buy that thing, right? So you buy the insurance, and what's the delta? 57. So we go ahead. Could we do it? Well, look at this. We've only got 148 on the open interest. Can't do it. Not even on Apple. Can't even buy a call option on, oh, this is Google. Can't even buy a call option on Google because you need to have the open interest to be about 1,000. You could buy this one up here. You buy, well, all of them suck. The spread is $15. It's not that. Look at this spread on that one's $115, $125. Wow, that's ridiculous. Can't do that. This one's not bad. $10 on the spread. You got 850 here, 269 here. You could do that one, but the problem is you're not going to have a full coverage on that one. You're going to have 47 on the delta, and you're going to have 57 delta on the shares. So you could do 47. We could do that. I guess you could do that. Let's go ahead and do it as an example. We're going to come in here. We're going to buy this. Oh, we already bought it. So it's already up here. So we're going to buy one of those, and we're going to go in here and just going to go mark it. We'll mark it in. This is doing it backwards from the put. This is the call. Is it going to mark it in? It's not going to let us mark it in. Oh, there it goes. It failed. All right. So that means now at the money, we're going to have to buy, since we got 47, we're going to have to buy 47 shares. So we got coverage of 47. So we're going to go 47. Okay, so we're going to buy the market. Oh, actually, we're going to sell the market. We have to sell it because we're doing calls. So we sell the shares. So it's easy to borrow, meaning that you're going to short the market. Okay, but you got your insurance policy to the upside. So you did 47 shares. So your insurance policy is covering you at 47. So there you go. Market goes down, you're going to make money. If the market goes up, you're going to make money. And you want to be, remember, the name of this game is not to hold that insurance policy forever. You want to get rid of that thing as soon as you got a confirmation that the market's going in your favor, you're making money. All right. So that's how that one works. Let's come in here and see. So we'd actually make more money if the market went up. Okay. Got that? You could, if you did that, if market went up because you bought the call, you could liquidate the short, you could liquidate the shares and just ride the call. It's 113 days because you make a lot of money on the call. So that's a nice way to do it. If you think the market's going to reverse and go, you could do it like this. That's a good way to do it. All right, so we're going to come in here to mags. Oh, mags. Everybody's flushing like a toilet. So let's come in here with our Fibonacci ruler. Where is the delta cone of probability? We're at 38.2 right now. The cone of probability, or the one standard deviation, is right here. Right there. So we haven't got back to the one standard deviation of the entire run yet. It's there. It's close. It's bouncing off the top of it. It's right there at the 38.2. It's right at knocking at the door. Knocking at the door. I think it'll come down in here, don't you? I think it'll come down in here. I think it'll come down into 50, maybe even 68 point to the bottom. I don't know. And down in here somewhere. We'll look for it to come in here somewhere, and then we'll look for it to start going sideways a little bit like this. And then we'll look for it to break and go up. But we got to have a left shoulder. See, we don't have a left shoulder yet. This is coming down. Maybe we'll create a left shoulder in here, come down. Maybe it'll take a little longer. I don't know. Nobody knows. But if you think it's going to go down, you can do the same thing. You can't short this one, mags. See, no, easy to borrow up there in the right corner. Easy to borrow, meaning you can't take it short. So you can't do your little call option thing here. You could say the put option thing. You could come in here and say, okay, all right, well, let's see if there's option. No, there's not. There's no option. Nobody's trading options. Oh, my, let's go to Meta. Wow, look at Meta. Dropping like a rock. They're dropping out of here like flies. Whew, whew, whew. Okay, so that's what we're going to do here. We're going to come in here. Can we do calls here? No, you can't even do it here. Well, you could do it up here. You could buy a call out of the money. Not really. Look, there's not even any open interest at the 113 days. Let's go a little shorter. Let's go 50 days. Oh my gosh. Everybody's little short timers nowadays, 22 days. They're not even doing that on look, you can't even buy a call on Meta. That's sad. What about puts? I bet everybody's buying puts right now. Oh, look, everybody's buying puts. Everybody's buying puts after the market's already after the they're all buying puts after the house is already on fire. But look at them. Look at the put. The theoretical value is 2042, and you can buy them for 2020. You can buy a put option today for less money than what it's worth. That's crazy. But it's only got 22 days. People are trading strategies on this one. 22-day strategies. Well, you can come in here and you say, okay, this is what's happening. Okay, let's do the wheel strategy. What is that? Well, that's where you come in here. Let's go back over to this little thing here. Let's go back over to this little thing here. All right. So what we're going to do is we're going to do the cash secured put. We're just going to sell a put down here under the market. All right. And so what that means to us is that it means we want to buy some of this down here as it pulls back. So we're going to come in here. We're going to sell a put. I'm going to show you a little trick that I like to do. If you sell the put down here, you say, okay, within the next 22 days, if the market comes down here, I'm going to sell a put. And look, I can come clear down here. I can put that. Let's put it right there at that's roughly $300. So if you sell that put right there, you're going to have it's called cash secured because you're going to have, well, they're margining you at $7,498. But you're going to have the cash to cover that in case. What that means is that's just a limit order. It's the same thing as putting a limit order here. You come in here and you go over to your trading tab and you put a limit order in here. Everybody understands limit order, right? You put that in there. That means that this market comes down here, then you're going to get filled 100. Well, in this case, 47 shares. Let's do exit chart. Put that back to 100 limit. You're going to come in here, you put a limit order. And if you do that, you're going to get filled 100 shares, right? That's all that means. That means that it's a buy 100 shares with a limit, which means you're putting a price in there. You're saying, if the market comes down to that level, give me 100 shares. Well, if you're going to do that anyway, why not get paid for it? So now you can come in here and you can say, I'm going to come in here and I'm going to use a put option. And I'm just going to sell my put option at the exact same thing. And it's going to come in here and it says, okay, if I put my put option in there, and that means I want to buy 100 shares of Meta at that price. And if it doesn't come down there, if Meta comes down here and hits the purple line above the red line, well, I get my $197 in this case. See, $197. I get to get my $197. Theoretical value is only 110. So you're getting something that's worth 109 for 197. You're getting a huge value on that. So it's only worth 109. You can sell it for 196. People want them now. Oh, look, everybody's buying them because their house is on fire, so they want to buy them. So insurance is expensive. 196 for something that's only worth 110. So you can sell that right now. And then if the market did come down, now here's the game. Here's the carnival game. It has to hit the purple line underneath the red line. If that happens, then you get your 100 shares, which is what you wanted anyway, right? Because you just substituted a limit order for a put order. And then you still get to keep your $199. So now they're going to pay you $199 to put an order in that says, give me 100 shares. But what if the market comes down here and hits the purple line above the red line? Well, you don't get your 100 shares. Sorry. But you still get the consolation prize of your $200. You still get your $200, but you don't get the shares. Well, Len, what if I really didn't want the shares? Because if I had the shares, I have to have $46,000 worth of stock. I have to buy $46,000. So I have to have $46,000 in the market. Yep. You have to have $46,000 available to put into the market if you do this. So they're probably not going to margin you at the full rate. Depends. Right here it says your margin rate is $7,000, but you're going to have $46,000 available. $46,000 available, because that's what that's telling you. I want to buy $46,000 worth of Meta. Len, I can't do this strategy. I don't have $46,000. Well, go do it on a market that's still got options, but is maybe trading for $80 a share. Then all you need is $8,000. Instead of $80,000 or $46,000. Trading a big market, but I wanted to find something that was quick and easy for us to find some options. So we just went to the Mag 7, because that's what everybody trades. That's all everybody wants to trade nowadays. It's just the AI stuff. That's where everybody's at. I'm getting sick of trading the Mag 7. I want to go trade something else. Those are big markets. Their shares are all like $595 a share. Percent gain is not as big when you got that kind of money. All right, so here we go. Receive $211. That's that. And that would be the wheel. Let's say you get filled. Now you have 100 shares of this one. So now what you do, once you have your 100 shares, let's say we got 100 shares. Okay, let's say that we had our option and we put it in there and it got filled. Now we have 100 shares. So we come in here, we buy, let's say we have 100 shares. So now you have 100 shares. Now what you do is you just keep doing that until you get your 100 shares. And once you get your 100 shares, then you just come in here and you go into your options and you sell a covered call. Sell a call. Now, what does a sell a call do? What does that do? Again, selling a call, that's the same exact thing. Let's kill that. It's the same exact thing as coming in here to your trading tab and putting a limit order in there. I'm going to sell with a limit. So a sell limit, because remember, limits are above. So that means I'm going to sell my shares at that price. That's all that means, right? A limit order, sell limit. I have 100 shares. If the market goes up to there, it means I'm going to sell my 100 shares. And how much money am I going to make? I'm going to make the amount of money between the green line and the red line. I'm going to make $6,529. That's not bad, right? That's nice. Oh, yeah, I think that's pretty nice. Now, here's where you come in with your C-Boss. This is where you get your monthly income. Because if you come in here every month and you do this, right, you just do the 30-day options. You can even do it every two weeks. You can do the 7-day options if there's enough. There is, look, plenty of volume, plenty of open interest. You could get a paycheck every 2 weeks. So you could just come in here and put your options in here, sell this one, collect the premium, and then get your shares if you get your shares. And if you don't get your shares, you just keep selling them every 2 weeks. Just keep selling them every 2 weeks, every 2 weeks, every 2 weeks. And if you're always out here and the market never comes down and makes you give you your shares, well, you just keep getting your $200, $200, $200, $200 every week. That's kind of cool, right? You could do that. That's why we do the wheel. It's income strategy. So you make money. And then when you got your shares, all you do is you put your limit order in there to get out. Say, well, I'll take my $6,529 in profit. Well, you're not going to really use a limit order, right? Because you want income. So we're going to come in here and we're going to sell a put or sell a call. So we'll sell a call. What does a sell a call mean? Let's go, that's 7 days. Let's go out and do our 22 days or our 50 days. Sell a call. We're going to sell a call. Look at this. We sell our call up here. We're going to get $1,000. Yeah, look at that. Receive $1,147 if you sell your call right there with a 50 days. They got 50 days to that market get up there. And if it gets up there, let's say it goes above it. Let's say it goes right up above it. You got to go above it. If it goes below it, 1 penny below it, you don't sell your shares. But you still get your $1,150. But your market's up $6,655. It just didn't hit your number that said sell your shares. So right there, you didn't sell your shares, but you got your $1,152 and you still got your shares. And you got $6,655 on there. But what if it goes up? What if it goes above the red line? Well, then you sell your shares at the purple line. You sell your shares. You no longer have your 100 shares because you sold them. They still give you the $1,165. You still get that. That's your income. Plus, you got $7,919. That's max profit. So if the market turns around, you have 100 shares, you put your order up there, your covered call, and it received $1,167, and it touches and it hits the purple line above the red line. That's all you're doing. It's a carnival game. Touches the purple line above the red line, you get what? 7,919. Actually, you don't get the 7,000. You get it right at the red line. Anything above there, you don't get. So if it went way up here, well, you didn't get the $20,000. You only get where you sold your shares at. You sold them right here. So you'll sell them right there. You'll get your $7,402 plus you get your $1,167. There you go. Yeah, made a little bit of money. Max profit. That's your income. And then once you got your money, then what you do is you sell your shares there, and then you just put another put option in there, and you sell another put option down here, and you do the same thing all over again. That's why they call it the wheel, because you just sell a put, collect the premium until you get your shares. Once you got your shares, you sell your call until they take them away. So you give them to you, they give you your shares, they take your shares away. They give you your shares, they take your shares away. They give you your shares, they take your shares away. And you just make the money between the two red lines. And you get to keep the premium. That's all there is to it. That's called the wheel strategy. Very simple, very easy. All right. Try it. Do it sometime. It's easy. It's just like having shares. You can do it. You can do it without doing the wheel. You don't even have to use the put option. So, oh, I have 100 shares. I'm going to sell a call right up here. It's called a covered call. That's why people do covered calls, because then you get to keep the money between here and there, 7,122, and you get to keep the 1,150. And if it doesn't go up there, what if the market just keeps going down? Well, you're losing money on the shares. That sucks, right? But we know how to solve that problem. We buy a put when we buy the shares. So now you can come in here, and now you're getting too fancy for me, Lan. I can't handle all this fanciness. Watch this. We got 100 shares. We're going to come in here, and we're going to buy a put. So we're going to buy a put. This is called your covered. This is your covered wheel. So we're going to come in here. We're going to buy a put, and we're not going to only buy one. We're going to buy two, so that we get a delta of 100, because we got 100 shares. If we want to do half of it, we can do half of it, right? We can do half of it. So, but we're going to do two of them right here. So we can buy two insurance policies, and we can also, so we can go in there, and we can also sell a call up here, and we're going to collect 1,267 from that one, and we're going to protect ourselves to the downside. If the market keeps flushing down, we'll actually make more money than we're losing on the shares, because we're doing the exact same thing we just did before, right? Protect the downside. Because we got delta 46, we bought 100 shares. If we only want to do 50 shares, we could do that. But then we have an option up here. We're selling 100. We're only going to sell 50 shares. We're going to be upside down. They're not going to let us do that. We got to have equal amounts. All right. I mean, they'll let you do it. You just have a big margin. So that's a protected put. That's a protected covered call. So now you got your shares, and you got your protection to the downside, and you're golden, man. You're golden. You can also do it another way too. Let's do another way. So we come in here. This gives you 100% protection to the downside. Now remember, if it flushes down, you're going to make a bunch of money here. You're going to lose some money up here. Actually, you got to keep that. You're going to make all that 1,280. You're going to lose money on the shares, but the shares are going to make more money on your options than you're losing on your shares, and you got to keep your premium up here 1,280. Should just put this on. Let's go ahead and put this on. We don't have enough buying power. We don't have enough. We got all of our money spent. It'll probably let us do it because it's a demo account market. Let's see if it'll let us in there. Yeah, it let us do it anyway. Okay, we have a $19,000 margin call. Okay. So now we just collected 1,260. We bought insurance for we bought 100 days of insurance, and we bought two of them, so that's $7,000. That's okay. No big deal. We got 100 shares long. Now, if the market flushes, we're going to make more money than we'll lose, because we would actually, in this case, you'd actually want the market to flush. That would be really cool if the market flushed right now. You'd make a lot of money because you're going to receive your 1,260. Of course, that's by as long as the market doesn't hit the, if the market flushes, chances of it going above there and hitting above that line there, pretty low. So if it comes down here and hits the line, you still get your 1,260 plus whatever profit the options are making, and then you can liquidate the options because you got 100 days. You don't need to keep that, and then your shares are losing money, but you're making more money on the option than you're losing on your shares. Not much, but a little bit. So you can just liquidate at any time. Take your little bit of profit off. Do what you want. It's fun. It's a game. It's just a game we're playing. Right? Once you learn how all the pieces move, right? I say that all the time. I tell you, it's just a game we're playing. And it's called the stock market game. Stock market game. Life rules to live by. The stock market is part strategy, part luck, and you're playing against the pros. To win, you need to know the game and the rules. And that's all we're doing. We're sitting around a big table. We're playing the game of life. The stock market is a game, and you're playing against these guys here. And they've been playing a long time. So we have to, as small speculators, we have to know what the rules are. So you have to lift up the box, and you have to read the back of the rules, right? How many of you ever played a board game? The rules are on the back of the box. How many of you tried playing a board game without reading the rules? That's what most people are doing when they come and trade in the stock market. They haven't read the rules. They're just playing the game. Spin, spin. Oh, roll the dice. Oh, I got these cards. I'm not sure what to do with them. Well, since I don't know what to do with these cards, I'll just set them over here. Oh, well, the reason. Well, now you're not going to win the game because you just set the cards aside that's going to help you win the game. That's the problem with not understanding how to do a lot of this stuff, right? I don't know how to trade options. I'm not going to trade options. Okay, well, it's part of the stock market game. And if you don't know how to use those cards in the game, well, you're probably not going to win the game. There's ways that you can use those extra tools in the stock market to win the game. It's just a game. And if you don't know how to play the game, you probably shouldn't be sitting at the table. I know, sounds tough, but that's all it is. We're just playing a big game, playing the game of life. And if you don't know the rules, why are you playing? That's why we're here, Lan. Stop complaining to us. I'm preaching to the choir. I know, you're here to learn. Good for you. I'm glad you're here. All right, so we're learning the game of life. And that's all we're doing. It's just one big game of life is one big carnival game. And all it is you draw lines on the screen. And if the market goes to this line, you make money. If it goes below this line with this strategy here, you make money too. So you make money no matter what on this one. How do you lose money on this one, Lan? I don't know. The worst thing you can have happen is have this market just go sideways. That's how you can lose money. If it just goes sideways. Why would you lose money if it went sideways? Well, because you paid for some insurance. You paid $7,000 for this insurance, but it's good for 100 days. Oh, this is only insurance good for 50 days. It's 50-day insurance, but we bought 2 of them. So that's where you're going to lose money. If this market just goes sideways, you're going to lose money. So that's how you lose money on this one. You just don't want a sideways market. If it just sits there, here you go. If you'd have put it on right there, you'd have lost money because your 50-day insurance policy would have decayed away to nothing. Why the market didn't move anywhere? You still made 1,260. All right, and the shares would have made nothing, and your insurance policy would have just bled out. You just bleed out your insurance premium. That's how you lose money. You buy insurance and you don't use it, and you paid for it. It's expensive, $7,000. 50 days. So you're just going to lose $7,000 over that 50 days. So you want to make a decision very fast. You want this market to either bullet down or bullet up. Because if it just goes sideways, that's where you start to lose money. All right. So not everything is perfect, but this is about as perfect as it gets. Let's go to Microsoft. Oh, Microsoft's another flusher, another toilet flusher. This is why I have $250,000 on the downside of these markets. I'm short all of these AI markets. And I have option premium insurance for the ones that I'm long. I have insurance protecting me to the downside so I can sleep at night. Okay, so we got Microsoft. Let's come into Microsoft. What's Microsoft? It's flushing like a toilet. What do we want to do? We can say, I want to run the wheel. I'm going to show you a little trick with the wheel. All right, here's a wheel strategy that you can do to protect yourself. First of all, we can come in and we sell our put. We can sell our 50-day put right here, and we're going to collect $600. Now, what that means is we're not going to get our shares until the market comes down to here, right? It's got to hit the purple line. Got to be underneath the red line. And the thing is that here's one of the caveats too. You have to take into consideration. What if it hits the purple line way down here? Well, it's going to give you the shares at your red line. So you get the shares right here. So you're going to get your $607, but you're going to have shares at 33,000 that are only worth 24,000. Okay, so you're going to lose that money. But it's okay. Microsoft generally comes back up. That's why you never want to do this strategy on a stock that you don't want the shares on anyway. I'm a buy and hold guy anyway, Lan. Okay, well, then buy and hold them at this point. That's still probably a pretty good price to have Apple. But if it does come down here, or this is Microsoft. So if it does come down here, you're going to have shares, 100 shares at this price. You're going to buy $33,000 worth of shares. If it comes down to this price, they're only going to be worth 27,000. 28, 29, 30, 31, 2, 33. You lost $6,000. But you still own them forever, right? There's no expiration date on shares. And so if the market then turns around and comes back up, you'll eventually get your money back. But in the meantime, that's when you're going to do your covered calls. right? You're going to sell covered calls and collect another $600, $600. Eventually, you could sell your shares, or you're not. You just keep rolling them out. You could roll your option out, and that's another strategy. We'll go into option rolling at another time. We're kind of running out of time because I want to show you how you can protect this one here. Because there's another couple strategies you can do here. So let's say we're going to put on our option here like this. All right. And this, we're going to get our shares in the next 50 days. If it comes down underneath there and touches the purple line, we're going to get our shares. And what we can do is we can say, well, what about my protection land? Am I going to buy my put? Am I going to buy my put up here? No, that's $1,800 for put at the money. And then that means you'd make money as soon as it started to fall. And your $600 isn't going to pay for that. So we actually bring our insurance policy down underneath our red line. So our insurance policy at this point is going to be $223. We're going to receive $592. And so we're not going to get as much money. We're not going to get as much money, right? $592 because we have to pay for our insurance policy. So you can see our little calculator over here says we're going to receive $369. $369, and our return on our risk can be 12%. 12%, that's a lot of money. Holy cow, 12% in 50 days. Again, like yesterday, how many 50 days are there in a year? We're going to come in here with our little calculator, and we're going to go 365. 365 divided by 50. There are 7.3 days. Let's just say 7. 7 times 12% is 87% annualized return. That's a lot of money if you just did that every 50 days, right? But what if you got your shares? Well, okay, then you own the shares. Then you do your covered calls and you get your money anyway. So you're still going to get roughly 87% annualized return. And you're going to just play your shares back and forth too. Sometimes you're going to get your shares taken away and you get it max profit. You're going to get that $6,000 too. Well, that's nice. Way to go. Good bully for you. All right. So that's the name of the game. But here's my little trick. Here's what I like to do. I like to not do this. This is not my strategy. I don't, well, you can do this. You can do this. $597. You're going to get your $369. And if the market stays above it, right? It's got to stay above there. Otherwise, you might get your shares, right? You get your shares if it clicks down here. And this insurance policy, it's going to make money. And you're going to have a little bit of a loss, but it's going to cover, it's there. It's going to work. The reason the insurance policy is there is in case you have a catastrophic explosion down here. And then the insurance policy is going to cover you. But if the insurance, if it comes in here, even down in here anyway, that insurance policy is not going to make enough money to offset hardly anything. All right, it's only a catastrophic piece of insurance. That's all it's going to do. It's going to cover you if it's way down here. So anywhere in here, you're just playing the wheel strategy. You're going to get your $597. You paid $224 for catastrophic insurance. You're going to get your $369, which is 12% annualized, 12% return in 50 days, or 80% annualized return. So that's good. You're happy. You're going to get your shares, or if it hits the purple line above the red line, you're going to get your $597 minus your $224. That's the game. I don't like to do that game. Here's what I like to do. Why don't I wait until the market looks like it's going to turn around and go back up? I'm going to wait, because if the market starts to fall, well, it starts to look like you're losing money. $597, it'll sit there and say, hey, you're losing money, losing money, losing money, losing money, losing money. You're not really losing money. That number doesn't apply to you. That's only if you bail out of your contract. Your contract is to take the shares at the purple line. That's what you contracted for. So it'll show that you're losing money the whole time this market's coming down. It's going to show you're losing money, you're losing money, you're losing money. You're scared. Oh no, I'm going to bed scared. You're not going to really lose money. You're just not losing. You're just, the difference between what you could have sold the shares for and what you're going to buy them at is losing money. You're still going to make your $597. You're still going to pay your $224, and you're going to buy the shares at this level. But if you bail out of the contract early and the market was here and it comes down, well, you're going to lose money. If you bail out early, you're going to have to pay that number that says you're losing. But you only have to pay that number that says you're losing if you bail out early. If you don't bail out early, you have to take your shares. Oh, I didn't really want to take my shares. I wanted to bail out early. Well, then if the market comes down, you're going to bail out early. You're going to lose your money. You're going to lose money. So here's what I like to do. I like to wait till the market looks like it's going to actually be down here at the bottom. I think I'm pretty good at reading where this little snaky thing's going. I do good TA. All right. I'm pretty good at my TA. My TA is getting better. My TA is pretty good. So I can pretty good at guessing when markets are going to bottom out. I watch my mathematical models, my indicators, my Fibonacci numbers, my counts. I count my waves, and I get pretty good at guessing at where markets are going to turn around. And so if markets are going to come down, make a little head and shoulders formation, it looks like it's going to go back up, right? I'll come and I'll put my order, this order right here, I'll put it right at the money, right there. And right where I think it's going to turn and go back up, right where I'm getting a buy signal or something where I think it's going to go up. I'll put that option right at the money. I don't put it way down here, because if I put it way down here, look how much I get, $600. Let's clear this one out just to clean things up. If I put my option way down here, well, I'm going to get $270. Oh, that's great. You're going to get $270. And you got this buffer. That's what you're buying. You're buying this buffer right here. So you're saying, but if the market comes down, I got anywhere in that buffer, I still get my 270 and I don't have to buy the shares. But it's going to look like you're losing money the whole way down. So what I do is I wait for it to come down there. It looks like it's going to come down there. So if you put the option right at the money, right there, look how much money you make, $1,800. $1,800 versus this one down here that's $200. Which would you rather have, $200 or $1,800? I'd rather have $1,800. So what I do is I don't wait. I don't put this in here and say, well, if the market's coming down, I'll just, come down, I'll get $200. No. Just don't put the order on until the market looks like it's going to go up. Just wait. Just sit there and sit out. Don't put your order in. Wait until you think that market's going up, and then sell your put right at the money. Boom, right there. $1,600. I'd rather take the $1,600 in anticipation the market's going to go up. But I'm going to wait until it looks like the market's going to go up. And then I get my $1,600. And then if the market goes up, like I think, right, then I might not ever get the shares because the market's going up. So I'm not going to get my shares, but I'll still get the $1,600 instead of the $200 or the $300. I get $1,600. So the difference between sell a put here and selling a put here, you get $270 or you get $1,600. Which would you prefer? All you have to do is time whether you think the market's going to not not close, not hit underneath the red line. And then you don't get your shares, you get your money. I'd rather have the $1,600. So I'm going to wait until the market comes down to a point where it looks like it's going to turn around and start to go up. That's where I sell my option. I don't sell my option. I'll wait for the market looks like it's going to turn around and then sell my option way down here and only take $200. Why did I wait? The reason I waited because I think the market's going to turn around and go up so I can put my order right at the money, $1,600. Yes, but land, if it doesn't go up, if it goes up like this a little bit and then comes down, you're going to get your shares at that price. Yeah, but I waited for it to come down to where I wanted them anyway. I would have bought the shares at that price anyway. So I might as well get $1,600 instead of $190. That's all I'm saying. That's all I'm saying. Boom. Do what you want. That's what I like to do. I'm not telling you what to do. I'm just telling you what I like to do. So I like to sell them right at the money. And I'll wait until the market comes to my point where I want to get them. So right here, I can say, are you trading Microsoft? Yes, I am. I'm in Microsoft right now. What do you mean? I don't see any orders. I'm on the sideline on Microsoft waiting for it to bottom out and start to look like it's going to turn around. I'm going to sell my put option right there. That's where I'm going to sell my put option. So I'm waiting every day, waiting till the market gets to a point where I want to sell my put option, which is where I want to buy the shares at anyway. Right at the point you want to buy your shares, where you think the market's at the perfect spot to buy the shares, don't buy them. Sell the put option right at the money. Sell the put right there. Boom. I want shares, sell the put. You're going to give you $1,800 to sell your shares, to buy your shares right there. Of course, you're not going to get your shares if the market turns around and goes back up. You're going to get your $1,800 instead. But if the market comes over here and touches that purple line underneath the red line, well, you're going to get your shares at the price you were going to buy them at anyway. And if you want to, you can say, I'm going to put this order in there, and then you can cover yourself with an insurance policy. You can come down here and say, well, I'm going to buy another put down here. Okay, I'm going to buy a put down here. So I'm going to sell my shares here, sell a put here, buy a put here. $1,800, $600, a lot more money. You buy your insurance way down here. Well, if you're going to buy insurance way down here anyway, and you're going to put this down here, buy your shares here, might as well put your shares there, get the $1,800, put your insurance up there. There you go, $320 insurance. It's just catastrophic insurance anyway. So you get $320, $1,850. You're going to make a lot more money. The thing is, you have to do your little bit of timing. Remember, it comes back to, well, how good are you at picking market direction? Not very good at it, Lan. Okay, well, practice. Practice, practice, practice. And put protection on. Buy insurance. The worse you are at guessing the direction of the market, the more insurance you need to pay. So you $1,800, you buy $1,250 worth of insurance. You're going to make $600 with a 40% annualized return. That's still a lot of money. Still a lot of money. You're just playing a bigger boy game, right? You can do it right here. You're still going to make $433. You got insurance right there. $1,437 worth of insurance, but you're getting $1,800. You're still getting $433. Yeah, but I could do that down here. You could do that down here, make $400. You could. Well, that's only $41. But then your insurance isn't as good. How are we going to get $400 out of that thing? $322. We're going to have to go to $400. We're going to have to go here to get $400. And then our insurance premium be about right there. So that'd be $450. You get 11% return. So that'd be basically the same thing. You're going to get $600 and pay $160. See how the game's played? See how the game's played? It's just one big game. One big game. All you're doing is just playing a game. Just got to pick up the box lid and read the rules. Learn how the game's played. All right, guys, that's all I got for you today. Practice, 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 practice. Put a lot of these on. Do them yourself. And play the game. Learn to play the game. Pretty soon, you're going to get good at it. You're going to be doing this with demo account for, I don't know. It's going to take you a little bit, maybe 3-4 months doing the demo account. And then you're going to not be ready, but you're going to be willing. You're not going to be ready, but you're going to be willing. And you're going to put one on. And you're going to go, oh, my gosh, that's the most exciting thing I ever did in my life. And then you're going to be hooked. You're never going to want to quit. You're going to want to do it for the rest of your life. Ask me how I know. All right, guys, I'm going to let you go. I have one thing to show you here. We are talking about Pit News Magazine. Pit News Magazine is really coming along a long ways. We've changed the name over to SFO Magazine. So Claire wants to tell you about that. I'll let Claire tell you a little bit about that if you guys want to stick around for just a minute and listen to Claire talk to you.
Hey everyone, it's Claire. Okay, so before we get into anything else, I need to get something off my chest. And I'm a little nervous saying this out loud, so just stick with me here. You might notice something different. Pit News Magazine has a new name. And yes, this might be my fault. I may have gently, very gently, nudged Mr. Turner into a conversation that turned into another conversation, which somehow turned into a full-on name change. I swear that wasn't the original plan. I was just asking questions. Innocent questions. Like, what if the name told people exactly what they're getting? You know, totally harmless. So, Pit News Magazine is now SFO Magazine. Stocks, futures, options. That's it. That's what we do. No mystery, no decoding required. Now, full transparency. I'm still a little unsure if this was the right move. I mean, Pit News has been around for a long time. It has history. It has personality. And Mr. Turner definitely gave me that look when I first brought it up. You know the one. The I'm listening but I'm not convinced look. But the more we talked about it, the more it made sense. SFO Magazine tells new readers exactly what they're opening before they even click. No guessing, no assumptions, just clarity. So if you're wondering who to blame, hi, it's me. If you love it, I'll absolutely take credit. If you hate it, I'll be hiding behind my keyboard for a few weeks. Seriously though, we hope you like the new name. Same magazine, same content, same slightly opinionated takes on the markets. Just a cleaner label on the front. Let us know what you think. And thanks for sticking with us. Name change and all.
All right, name change and all. One more thing for you here real quick, just for you guys who haven't got Track and Trade yet.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
Okay, I think we learned a valuable lesson today. We can't put options on every single thing that we think we want to. We wanted to put a bunch of options on the military stuff, and nobody's trading them with options, which is crazy to me. I don't understand why people are not trading those with options. Those are great option trading stocks, but they're not. So we can only go where our friends are, and our friends happen to be right now all stuck around the AI markets. So we go and kind of focus on those for now. We'll find some others. There's some that are less expensive that have some options on them. We'll do a little bit of research. I'll have a nice list for you next week. And we'll look at some options that have less expensive premiums with large open volume and open interest. All right. So I'll do that little research for you, so we can have some smaller markets, and we'll come back and we'll do that next week. So join me next week. It'll be next Tuesday, probably 9 o'clock in the morning, just like usual, and we'll do some more options trading. We'll have some more shares, some more markets for you to trade. Okay, guys, we'll see you. If you had fun, give it the thumbs up. We always like to see those little thumbs up. That's always fun to see that some of you like the class. So we'll see you next time. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.